Ajay Srivastava, Managing Director at Dimensions Corporate Finance Services, joins us right now on the show. And Ajay, really appreciate you joining in, but you obviously, I mean, the market yesterday, the comments that came in from the CA all lead to some fairly serious introspection on what to do now. We've probably been the worst, or we have been the worst performing market since the peak on June 3rd. The question is, if indeed a government-induced stimulus is not coming in a hurry, or it's difficult to predict, what happens to the market in the intermediate term in the absence of almost any trigger that we can look forward to?
Good morning, Neeraj. I think as investors, we need to look at three things. One is we need to start as Indians, start to look at a global market for investment, not just focus on India. 99.9% Indians have got 100% equity investments in India. And I think it is time for them to start looking elsewhere as well, because if you see the conduct of what's happening in the US and India, it is so stark. There they have a president gunning for getting the economy back and seeing it up. Here we have a flippant CA, attributing some demonic transformation of the economy to this slowdown. So, the comparison is so odious at this point of time that you would wonder, why have you invested any money in India and not in the US? So I think the first lesson for us, instead of trying to understand when the stimulus will come, if it comes, because I hope people have heard the old adage, a stitch in time saves nine. What could have been done with 100 rupees now will maybe need 500 rupees. So I think the first step Indian investors should look at is, please diversify your investments across the world, particularly United States, rather than just sticking to India and living with it. Number two, having said we had a steep correction, if you look at the top 10 stocks, Neeraj, which is, let's say, HDFC, Bajaj, etc., they're not cheap by any standard given the economy at this stage. Even today, they're running at a PE of 25 and abouts, and they're about book values of 8 to 10, like Bajaj Twins, etc. So you're not saying that some of the stocks have become as cheap as they should have been given the economy. Number three is, we must understand that there is a big problem happening in the economy, that the MSMEs are still paying interest rate between 12 and 18%. And you're right, Neeraj, I'll tell you, we have a company who's come to us for restructuring. SBI levied an interest rate of 18% because they couldn't meet the covenants. Have you ever heard you talk of interest rate reduction? They levied 18% interest rate, ICICI and SBI. So wow. This interest rate chimera of reduction is all for the newspapers. What is the real rate being paid by the real India is 12 to 18%. Unbelievable, but that is true. So in that scenario, I think three things are very ordered. Don't fret too much. Diversify your holdings. Don't invest. If you got the money, just keep it there. Whatever you have investment, it's mostly should be underwater by now. Just hold on to it and hope it turns around. At some point of time, it will turn around. And as we said, this is the best time to buy a house. If you have money, just go buy a house if you wanted to, rather than just trying to double your money in equity. So all in all, live with it, but diversify.
Ajay, for now, okay, there are a couple of things. I mean, experts like you, I think with interest abroad as well, likely could diversify in a much easier fashion. I think the costs of buying equities directly abroad is a bit more prohibitive for somebody whose investment corpus is not as high. So my question is, again, from both people's perspective, I take on board your point that if you have the wherewithal and if you have the money, go out and try and diversify out of India too. It's just prudent, irrespective of what's happening right now, it's just prudent to do that. For people who can't do that, what's the belief that you have right now about the near term, looking at the economic forces at play, looking at the responses from the finance ministry, PMO and otherwise, and the fact that earnings are at least a month and a half away and they do not promise to set the stage on fire? Would you believe that there will be a slow drag downwards for the Indian markets from where they are right now?
So three things. One, you asked is, what do people do who can't buy equity overseas directly? I think you still have a window of US mutual fund, particularly available in India. Some mutual funds are international mutual funds, which is not a bad way to get into the US markets and international markets. They're pretty decent funds, and the portfolios are quite decent. We analyze them and we use them ourselves. So it's quite decent to put the money, and you need to put the money in rupees, so you don't even worry about norms, using your norms quota, etc. So to that extent, even a small retail investor with 25,000 can start participating in the U.S. market. It's quite simple. Number two is, even when we look at this Indian economy, I think there will be few bright spots as always. You've seen IT was absolutely fine yesterday. Nothing went wrong with IT. IT will remain to be a good bellwether for Indian investors. If you are there, keep it going. If you're an FMCG, MNC, keep it going. Sooner or later, they will keep rewarding with dividends. I think the key question has become that what do you do with the old economy stocks? And that is where the dilemma is. And number two, biggest one, 90% of Indians hold large holdings in banking. And I think that's where the big damage is coming, because barring one or two, even HDFC has dropped 10% at this point of time. What do you do with banks? I think you need to just stay put with top 3 companies of every industry. And hopefully when the market turns around, you will see the top 3 companies giving you extraordinary returns. Trying to do the alpha by small and mid cap is going to be as disastrous as been for the last 2 to 3 years. I think that's the moot point what we are telling all our investors. And the last point is earnings. At this point of time, earnings makes no sense, because you need to start looking at companies based upon their book value to market, their fixed assets to market capitalization, their debt to EBITDA multiples, because earnings will not justify anything at this stage, because this festive season looks to be pretty rotten by any standards. So start looking at the portfolio more in terms of what the valuation of the company is to intrinsic assets, then just look at the earning potential of the company. So as I repeat myself to summarize, we look at the top 3 of every industry and stick to that. And if you want to go level below, please look at intrinsic value of the company and if they are debt-free and compared to the asset of the company. If you think they're right and some of the commodity players perhaps would qualify for that investment, then you may stick around with it or maybe make some investments, because that could give you alpha returns whenever the market turns around. But banking on earnings, I think that would be a fool's paradise.